8 ways to make money in a bear market as an investor. For agile and active investors, a bear market doesn't mean that no profit can be made. As a matter of fact, bear markets provide opportunities for long-term wealth building for investors. 1. Short selling. Short selling, also called short position, is an investment strategy used by experienced investors during a price fall in the stock market. It occurs when the investor borrows shares to sell back with the belief that the stock price will fall in the future. If it goes as planned, and the price drops, you can buy the borrowed shares at a lower price to cover the short position and make a huge profit. For example, if you borrow stock XYZ at $40 per share and the stock price declines to $30, you can buy the stock back at $30 to close out the short position. Your profit here would be $10 per share. However, the risk of loss on a short sale is hypothetically unlimited since the price of any asset can rise massively. 2. Buying high-yield dividend stocks. Searching for dividend stocks can be a good way to find profit opportunities in a falling market. This is because dividends are backed by the company's net income while stock prices are determined by the stock market traders. If the stock prices decline, but the company is still generating income and pays dividends, it is a good opportunity for those seeking profit from dividend stocks. 3. Put options. A put option becomes more valuable as a price option decreases. In a bear market, a put option when an investor has the right but not the obligation to sell or short sell a stock at a particular strike price. A strike price is a predetermined price the buyer of the put option can sell the stock. A put option becomes more valuable when the underlying stock keeps falling. If the stock price goes beyond the strike price, you can sell it at a higher strike price or decide to sell the put option. Bear in mind that the put option differs from the call option, which we'll explain shortly. However, just like short selling, a put option loses its value if the price of the underlying stock increases. 4. Short ETFs. Short exchange-traded funds, also known as inverse ETF, is another investment security strategy that involves the collection of stocks that produce returns when the underlying price declines. Using ETFs is similar to short selling, but its difference is that the returns produced are inverse of the market index. This inverse relationship of ETFs makes it appropriate for investors who want to hedge against such a market downturn. It is also a good way to diversify into different sectors. Short ETFs enable investors to make money in a bear market, without having to short sell. Although they are not considered as long-term investment strategies, they are an alternative to short selling as your only loss is the amount you invest in ETF. 5. Buying call option. A call option is an assurance that a specific stock will increase in value within a short period of time. Buying call options is about playing the market, not investing. Remember, a call option is secondary, and it can expire if you're not careful. However, the good side of a call option is that it is not expensive to buy and tends to be a very cheap stock at the bottom of the stock market. 6. Writing covered calls. Writing a covered call means that you are selling a call option against a stock you own. This means that you accept an obligation to sell your stock to the holder, buyer, of the call option. If you choose to sell the stock to the buyer when it exceeds the strike price, you receive a premium option, known as the income. When the market is diminishing, investors may be contemplating selling their shares away to avoid losing money. Writing covered calls is a good way to make money from the bear market. The buyer hopes for the market to pick up, but if it doesn't, you get to keep your premium option. Another good side to writing covered calls is that whether the holder makes use of their call option, you will receive your premium for taking the risk of writing a covered call. 7. Acquire defensive stocks. A good way to secure your investment is to acquire defensive stocks. They are stocks of companies that provide consumer usables, so their product is constantly in demand regardless of the economy situation. A typical example of these kind of companies are food and beverage manufacturers. In a booming economy, investors tend to move into cyclical stocks. These are stocks from companies that manufacture needless products like electronics, autos, machines, etc. Stocks from these companies tend to do well in such an economy. However, in a declining economy, good investors tend to move to stocks of companies that produce consumer needs. This secures their investments and they make money in the bear market. 8. Buy good stocks. In a bear market, the value of both good stocks and bad stocks tend to go down. But good stocks recover and go back to growing while bad stocks stay down till the bear market ends. As an investor, the master plan is to identify stocks of strong and reputable companies whose prices declined and invest in them. But you will have to carry out a thorough research about the stock and company too, regardless of if it is a good stock. You can use a bond rating to determine if the company is safe and creditworthy. Ratings of AAA, AA, and A signifies that the particular company has reached a high level of creditworthiness, while lower ratings like B and C are flagged as risk investments. Basically, before you can know how to make money in a bear market, you have to first understand the bear market. Understanding the bear market. A general definition of a bear market says that it occurs when there is a 20% fall in stock price. When this happens, more investors switch from risk-seeking to risk-aversing investments because bear markets can last for a long period of time. Different factors can lead to a bear market, but the major factors that indicate that there is an impending market are: declining economy. A weak and falling economy is a major sign of a bear market. The low economy is seen by low income rates, a reduction in business profits, rising inflation, and low employment. When all these start to happen consistently, the stock market will experience a downturn. Failed market rallies. When there is an uptrend that has no purchase, it means that there is an impending bear market, downturn, and the bulls are no longer in control. Investors who see this know that something is about to happen and hence sell off their stocks to avoid losses. Conclusion. Bear markets are also a good opportunity to make profit. In fact, there are multiple ways to make money in a bear market. So long as you are a long-term investor, a bear market shouldn't make you panic. The right investment strategy would keep you from losing money in a bear market. Please like, comment, share and subscribe to my channel. Thanks for watching.